I think that, first of all, I want to thank Eyal for running through what he's done. From my perspective, I love to hear the presentation that someone from a credit rating agency provides, and I hope that everybody else on the call similarly felt that this was enjoyable and interesting, particularly because of the fact that a lot of us don't always appreciate all of the different elements that go into a credit rating. As Eyal shared, a credit rating includes so many different elements, not just the financial picture, but also a lot of the elements about what the entity is doing. So from a utility perspective, what is your anticipated growth? What is your internal corporate governance? What are all the things that would be important for a credit rating? Again, let's go back to the main point. The reason why we do a credit rating as a utility is because we want to be able to provide information in a standardized way so that institutional investors or other lenders have the opportunity to understand exactly what it is that we as a particular utility are doing. How do we stand up as looking at something both in objective terms, but also relative to the way that we're performing, if you consider X utility relative to, let's say, 20 or 30 other utilities. And so that's why I think that it's really important to make sure that there is transparency in this process and that there is accuracy on what the credit rating actually shows. I have a handful of additional slides that I'm going to run through, but again, I know that there are a lot of questions that people have, and looking through the questions that have come through, I see that there are some financial whizzes out there who are asking very detailed questions, and I look forward to engaging with you potentially one-on-one to discuss. And then a credit rating and what the benefits of a credit rating would be. So I'm going to try to skew more towards making this accessible for everybody, but I do recognize that some of you are financial experts who want to ask very particular questions, and happy to go through that. But like I said, I wanted to also get to a point where we're looking to see what the image of things is, not exclusively from a credit rating perspective on a utility, but imagining what the impact would be on accessibility of finance. And so I used this example, came from the Washington Post a few years back, and the analysis that this goes through is demonstrating that the higher the credit score, the lower the interest rates are that people would pay. So if you look at this picture, it's showing effectively that the interest rate that you're paying on your mortgage, if you have a higher individual or household credit rate, there is going to be a differential. So if you're at the top of what your credit rating could be, which in the US is between 750 and 850, you are going to be paying a significantly amount less on your mortgage over, let's say, a 30-year period of time. So if you imagine you're a utility and you could see interest rates on the loans that you're taking out of, let's say, 3.5% or 3.75% relative to being as high as 4.5% if you have low credit ratings, there is a tremendous difference. And what does that translate to? That translates to the amount that you're paying in your debt service. And that debt service that you're paying is interest and principal, which will take away the money that's available for other types of work that you want to do. So if you're paying a very high amount of money in terms of interest rates because you have a low credit rating, that means that you're going to be in a position that you don't have as much available cash to be paying for other things. And I think that that's a really important idea to keep in mind. And further, when we think about credit ratings and we think about the interest rates, remember what Eyal said earlier as far as the fact that the lower the cash flow is that you have available to be paying on future debt service, again, the lower your credit rating will be, which means the higher your interest rates will be. So when people say, do I really need to get a credit rating? I think that any entity that's looking to try to raise money from external sources should be considering a credit rating, whether it be a full-scale public credit rating, whether it be a shadow credit rating, whether it be an assessment, which is something which is less intensive than a credit rating. Any one of those is going to help to signal and also to give transparency to what you're doing so that investors can better understand. So talking about this from a water utility perspective, again, credit ratings have the potential to affect the cost of capital, the investment process, the accessibility to financial markets, and in turn, the overall value and the overall cost of doing business of a firm or a utility. There's an article that came out as a report just a few months back on the impact of credit ratings on capital structure. Again, I have links in all of the slides to those reports, so please feel free to look at this. But it's, I think, also a curious thing from this report is that it showed that firms will take preventative moves, especially to avoid unfavorable ratings and to maintain better ratings within either the grades or bands between investment and speculative, because they understand how critically important it is to have a favorable credit rating, i.e. one which is investment grade relative to speculative grade when you're in a mode of raising capital for your projects. So I wanted to share this both on the commercial bank side and on the impact investor side. So on the commercial bank side, people say, so give me examples of what this looks like within the water sector on the impact of credit ratings on financial instruments. I'll be honest, it's very difficult to assess because of the fact that there are limited examples of credit ratings going on in the water sector and for utilities across Africa and Asia. And even when you look more broadly, if we look in Europe and North America, there's not as high a prevalence, partially because of the fact that water utilities end up being part of municipal structures, partially because of the fact that a lot of them are not necessarily looking to raise capital or money on their own. But what I did see on doing just a quick review of the loans that have come through for utilities that are raising money from commercial banks, there's up to a 25% spread. So up to 25% differential between what an investment and a speculative grade borrower is seeing for water utilities in developing markets. And that's a pretty significant difference when you think about cost of capital. And again, going back to the overall financial statements that you'll be producing. Similarly, when we talk about impact investors, there's also a relatively low number of impact investors, first of all, in the WASH space. And as Chris said during his introduction to me, I'm the head of the deal team for a water impact investment fund. And so what I'm doing on the deployment of the capital that we have, and again, overall capitalization is $100 million. We're trying to figure out who we invest in and how we price either the debt that we're providing or the equity that we're providing, depending on the entity we're talking about. I see that some of the entities that we are likely to be investing in have joined the call. And so I know that many of them haven't gone through the process of credit ratings either, but we do our own internal credit rating process using a lot of the same metrics that GCR uses in order to determine what we think the creditworthiness of an entity is. And what is that measuring? Again, going back to that initial slide, creditworthiness is looking at the ability and willingness of the entity that we're either lending to or investing in to honor either that debt or to honor the equity payment that we're making in and pay us dividends in return. And how do we look at that? Again, our biggest question is really trying to understand whether or not we feel that there is that likelihood they will be, as utilities or as private sector entities, able to be in a position to pay back. So what we find, in all honesty, is that when we do the analysis, when we see that there is an entity that we think is poorly rated, we will prefer to go in as lenders of fixed income rather than as equity investors, because we question whether or not they will be able to honor their obligations or whether they will default. And even within that, when we think about lending, we probably will apply a premium that is reflective of what we anticipate that risk to look like. So when people ask, how does this actually play out? It plays out very significantly in the cost of capital that you as a utility or as a private sector entity will be able to access. This last slide that I wanted to go through is one that I've lifted from the Climate Finance Lab, and this is pretty much an exemplar of what the Kenya Pooled Water Fund is looking at. So if you look through this picture, you will see that there's the World Water Financing Facility, which is a donor-funded mechanism that helps to create these national level water financing facilities. and that these water financing facilities effectively pool together the demands from a number of water utilities that are all at a certain level. And those water utilities will then take the money that they receive in the form of loans to be able to implement the projects that they want to go through. All of that is the financial architecture, which is critically important, but it's not something that I want to spend too much time on today. Instead, what I want to really focus on is that each of these utilities that are going into the pool are not likely to have the exact same credit rating. And the typical rule is that the lowest rated utility ends up being reflective of what the pool in its entirety looks like to an outside investor, unless you're able to bring in some sort of credit enhancement that helps to mitigate the risk for investors. So to put it more simply, if I were looking as a lender to lend to an individual who has very low credit rating, and they come to me and they say, I'm looking to borrow 100 US dollars. I will probably look at them and do my own calculation of what their risk looks like. And I might say, I don't know if you're a great credit risk, so I'm going to apply a higher interest rate, potentially even higher than market interest rate, because I'm concerned about your likelihood of default. So I might say, I'll offer you the $100 at 8%. If somebody else comes in and they look a lot less risky, and I might say, I'll offer you $100 at 6%. And so they would say, well, that's great. Maybe we're looking to raise $200 in total. I will look at both of them and say, I still feel like I'm going to use the risk of my risk perception of the higher risk individual to calculate what I'll be charging. So I'll say both of you are paying the 8%. If I were the person coming in at 6%, I probably would say, look, that's not a great deal for me. I'd rather go on my own. But if we talk about a pool as is described on this screen, and let's say there's 5 different people all coming in and they're looking to borrow in aggregate 500 US dollars, and somebody else comes in, their wealthy uncle, and says, I will guarantee all of them are going to pay back, then I'll look not at the risk of each of the 5 guys who are standing in front of me trying to borrow $100, but instead I'll really look more at the risk of the uncle in the case that each of those 5 guys defaults. So if my risk analysis, again, if I were to pretend that I'm hiring GCR to do that risk analysis on all 5 of the potential borrowers plus the wealthy uncle, GCR might come back and say, these guys all are north of a 5% risk, but the wealthy uncle actually is one that you need to look at because he's the one guaranteeing all of the 5 will make good on their $500 in aggregate. Or if they default, he will pay you the full $100. In that case, I'm doing the analysis exclusively on that wealthy uncle. That wealthy uncle might end up carrying what I would call a risk of 2%. So that means that all of the 5 guys who come in to borrow from me at 6%, 8%, whatever it might be, end up now borrowing at 2%. So that means that their cost of capital is significantly lower. So that's the way that this pool works. And the reason why that pool ends up being successful is because of the fact that you have that external guarantor. Again, those guarantors can take the form of being credit enhancers from aid agencies, from development finance institutions, or from private sector players. And each of those end up coming through in different ways. But I think it's really important to understand why that guarantee is important. And within the water sector, it's particularly important if we think back to all the things we've discussed over the course of these 2 hours. So we've looked at the question of what is it that we're looking to borrow for as water utilities? As water utilities, we want to borrow for long-term investments. And so those long-term investments need to be matched against investors that want to take on that long-term exposure or to lend on a long-term basis. Those long-term lenders in many countries that we're talking about across Africa and Asia end up being the institutional investors who want to buy the bonds. And so those institutional investors will come in either as pension funds or insurance companies saying that they'll buy 10, 15-year exposure to you as a water utility, but they'll be concerned about what is this water utilities performance actually going to be. The way that we can make sure they feel comfortable is doing something like this pool, where there is a guarantee that helps to mitigate the risk, and that makes it something that fits within allowable investments for the domestic institutional investors. So I think that it's an important thing for us to keep in mind, in addition to those instances where there will be the individual or one-off transactions where it's a match between a utility that's looking to go to market to issue a bond and then institutional investors that are purchasing the debt of one particular player. I know that we went through quite a number of things over the course of today's conversation, and I'm also looking at the time. I see that we are about 20 minutes from the end of what everybody has scheduled, and so there is two things that I'd like to do. The first, I see that now we are up to almost 30 questions, which is very encouraging because it shows that everybody is interested in this topic. But the other thing that I want to do is to let you know that during the last few minutes of today's conversation, I'm going to turn it over to a colleague coming in from Castalia, who will talk about one of the things that she is working on, and something that will be the topic of the next lecture, lecture number 3. But before I do that, I do want to look through, maybe pull 1 or 2 different questions from this list, and then also see whether there's any questions from the floor.
Jeremy, one question that caught my eye had to do with the fact that many of the utilities in Africa and presumably globally, in addition to water supply, are also responsible for the provision of sanitation. And I think many of the commentators perceive that as being having a downward effect on credit ratings, i.e. that the sanitation component of their responsibility is not revenue generating, is only cost. And how does that affect their overall financial picture, and more specifically their credit rating?
So great question, and I'll answer that in a couple of different ways. Thanks, Chris. I guess the first thing, so yes, I would be showing ignorance of the sector if I were to say that sanitation is something where it's cost recovery. I know that water, particularly if you have low levels of non-revenue water, will end up generating enough money, and so you'll see full cost recovery in many instances. But when you talk about sanitation, you end up having a challenge in looking at that. And so there are 2 ways that I'll answer that question. The first, the picture is intended to be an overall capture of what you're doing. And so if we can see ways that national government or external development partners can come in and provide some sort of top up in order to subsidize what the cost is of sanitation, that's beneficial. But that only takes you so far. I looked through the list of people who are participants, and I'm not going to turn it over for him to share, but I see that Andrew from Sanitation has dialed in. And so Sanitation, as a private sector partner of water utilities, ends up looking not at sanitation or fecal sludge as being a deterrent, but instead sees it being something where, from a circular economy perspective, you can convert fecal sludge into a product which can be monetized and can end up feeding back into the utility. So I know that's a partial non-answer, because it doesn't necessarily get to the heart of what does sanitation look like on the balance sheet. But I do think that number one, we should start thinking about ways that we can view sanitation and fecal sludge not as a drain on the business, but instead as a source, an additional revenue source. And I also think that if I were a credit rating agency, I would recognize these are the parameters within which water utilities are working, and I wouldn't ding them in the way that I'm rating them, both on an objective basis, but also on a relative basis. If in a particular country, we know that every water utility has that responsibility, we won't end up singling those out, saying that they're not performing well. But I do think that it does bring up another point which is important, and that's the fact that a lot of utilities are increasingly exploring what does it look like to structure a public-private partnership. And if we can imagine structuring those public-private partnerships in a way that the utility ends up outsourcing some of those responsibilities, that can end up leading to a better overall outcome for what their financial picture might look like. But just going back to the earlier point, one that I want to stress, a credit rating is not exclusively looking at your financial performance. It's looking at a whole host of different elements. And I think that it would be dangerous to imagine that we need to look exclusively at financial performance in order to determine the strength of a credit rating of an entity.
Jeremy, that's a perfect segue. Several of our questions have addressed the concept of corporate governance and what impact that has on credit ratings. Eyal has volunteered to step in and address that. Eyal, are you there? Eyal?
Yeah, sorry, I'm. Okay, my camera says it's still blocked. But anyway, corporate governance, I mean, is a critical part of GCR's rating methodology. And I just alluded to looking at the Auditor General report, but we do a much more comprehensive assessment. Now, that's not to say that corporate governance is a notoriously difficult thing to identify definitely and see exactly what the impact is. But GCR's methodology is really to use a bunch of indicators and to really accord them neutral or negative factors. And then at the end of it, to go through to see, are there more neutrals or are there more negatives, and how severe are those negatives? So you'd look at things like the composition of the board. Now, you may not know every single board member and who they are, because I mean, you won't be familiar with that, but we would go and look at them. Do they have board memberships of other types of public sector entities, or more importantly, private sector entities? What are their degrees? What has been the history of the governing entity of appointing members to the board? First of all, what does the legislation allow or demand that they do? Have they interfered with the board in the past? What is the board's strategy? Has the board maintained a clear strategy over the last 5 or 10 years that has been adequately implemented? Or has there been lots of changes, and every year there's a new 5-year strategic document, which would be a negative factor? So there are all sorts of factors here that we would look at in making our corporate governance assessment. Now, in GCR's criteria, I mean, we generally believe that corporate governance will never give you a stronger rating, but it can certainly give you a weaker rating if it's not there. So everything I've shown you is actually part of a scoring system. So in the scoring system, the best score you could get for corporate governance would be a 0, but you could get a significantly minus score if corporate governance is not there. Like I said, I saw there was one question that asked about how you assess the severity of qualifications. Again, it's somewhat subjective, but it's really about weighing up all these subjective factors to see if you can make a more objective finding. So it's what are the say it's misspending money. What was the money misspent on? Why? Well, what do the findings say? What are the quantums of the money spent? Were they significant? Can they be explained? New management. So it's really that. It's trying to weigh up various findings and to make, which are generally subjective when it comes to corporate governance, but to come out with a more objective finding of corporate governance at the end, and using the Auditor General's tools, because they use a much more generally an objective standard, which may be sometimes too stringent, in some cases, or lenient, but they would use an objective standard. It's just one of the tools that we would include in our corporate governance assessments, as long as GCR has some faith in the Auditor General.
Chris, can I just ask Can I just
Go
ask
ahead,
a
Jeremy.
question of Eyal? So Eyal, I know that we have representatives from different WSPs in Kenya who have dialed in. And one of the questions that I would have, because I think it's important for us to get grounded rather than to talk in abstract terms.
Yeah.
In some WSPs, the governors have replaced the boards of directors overnight, and there has been considerable disruption as a result. How materially would you say that, so it's not the boards themselves, but it's the decision makers over the boards. How materially does that impact the way that you would credit rate an entity? Would you view that as being materially problematic, or is that something which is not that problematic? The reason why I'm asking is because part of ROCKBlue's goal is to help to advocate and to show that irresponsibility, or at least inconsistency in the way that water utilities operate, ends up having negative impact on access to finance. Would you say that there is a direct correlation between the let's say irregularities in board appointments and your credit ratings, which then directly would impact access to finance?
Yeah. Yeah, there's no question that irregularities in terms of appointing the boards would be a major red flag within the credit rating. And even if it is done in an instance it can be shown to have been the right decision, giving that type of power and authority and is open to abuse. And the problem is what I started off with was the sort of this juxtaposition between the private and public sector nature of water utilities. It gives rise to a lot of opportunities for abuse and a lot of vested interest in the process. And therefore, you do need these strong corporate governance measures in place to avoid these inherent pitfalls in the situation. So certainly a governor or a mayor or ever firing the board overnight would be a major red flag and problematic in the credit quality, because it really just shows that even the best work over years can be just overturned overnight. And therefore, as a creditor, as a lender, what's to stop that governor from turning around and saying, well, you know what, that was the previous governor that borrowed the money from you guys, but why I'm not paying it back? And really, you want to see that there's continuity. If you lend money, especially if you're doing it for long term, over a 10-year period, that it's the systems that are in place that will protect the repayment of that money, not the personalities that are in place at the time you lent the money. So therefore, that corporate governance becomes critical to have the correct systems in place to avoid those personality conflicts.
Hey, I want to move on from this question. I think that was a great exchange, but somewhat related to that is the idea of the emerging idea of the importance of what you might call ESG, environment, social, and governance objectives. And there are various rating systems for those, ISO 19001, some of the Global Compact work, et cetera. Jeremy, I know you're doing work now with the Green Finance Institute. Can you touch on how lenders or others or social impact investors are using that slightly different kind of rating in their investment decisions?
Sure, I'm happy to go through that, and I'll try to be relatively brief because I do know that we want to make sure everybody gets out in the next, I think, 10 minutes or less. But as far as ESG is concerned, people are increasingly looking at that. And I think that the increased focus on the ESG side of everything is helpful, but I think that there's a lack of standardization of what ESG actually means. So it becomes something which is applied potentially internally by a commercial lender or by an impact investor who says, I'd like to make sure that we're realizing all of these goals. I also, and this is my own personal bugaboo, I think that we need to separate out ESG. I think G, as far as governance, is something which we're already capturing in conducting these ratings. It's the E and the S, and impact investors, some of them will focus exclusively on the financial profit as a bottom line number alongside of the social goal. So how many people are impacted? What does this end up looking like? The other side is the environmental side, where people say, you know, we'd like to make sure that at least this is do no harm, if not reducing carbon impact or greenhouse gas or some of those other elements. The challenge ends up being, again, that there's not a clear way of looking at that. And there's also not a clear continued focus on that. So when we say environmental and that this is a project which is a green project, for example, it might be green in name and it might have green goals, but is there somebody who down the road is doing that monitoring and evaluation to ensure that it continues to maintain that green definition? So I think that we're going to see an increased focus on trying to standardize that, but I question whether or not credit rating agencies will have that appetite. I mean, credit rating agencies, and Eyal can speak on this better than I can, but they're for-profit entities. So if everybody wants this, I'm sure they'll find a way to offer that service. But I don't know whether or not we're going to see clear-cut ways of saying this is an entity which is investment grade on its ESG. And so I wish I could give a better answer, but I know even from what I'm doing on the impact investment side, I find that it's a wavy line rather than a clear-cut differential between investment and speculative. And I also feel like that gets more towards what I have as my investment goals rather than where I see the entity itself being rated. So I would love to continue that conversation and happy to point people towards things that they can read on their own. But again, I know that we have just a few minutes and we do want to allow for Castalia.
Yeah.
Jeremy, if we've got Castalia online, we should definitely transition over to that quickly.
So I think it was Shannon. Yeah, Shannon, I will go to the slide that you've shared and let you walk through. I don't know how we go about doing that. Chris, can you, I see that she's raised her hand. If you can help on that, that'd be great.
Yep,
Shannon.
everyone, can you hear me now?
Yes, loud and clear.
Great, excellent. Yeah, hi everyone, good morning, good afternoon. Yeah, so I'll be really brief. So yeah, what we'll be talking about at the next webinar, you know, we've been thinking a lot about how to design a financing facility specifically for the emergency pandemic response in light of COVID-19 and the impact that's had on utilities financially, both from, you know, decreasing cash flows due to customers not paying their bills, as well as the increased costs due to mandatory, you know, PPE requirements and more. So what this slide does here is it summarizes, you know, a facility at the end of the day can be and likely will be, you know, a somewhat complex entity, instrument, but at the end of the day, it really is all about getting money from, you know, from one source or from multiple sources, and dispersing that money to the utilities that really need it. And likely this will be done at a national level, since most of these sources of finance that can provide finance in the large quantities that utilities need, you know, need to lend through sovereign governments first. So it would flow from the Ministry of Finance through this facility. But then there do become a lot of design questions, such as, you know, how should this money be dispersed to utilities? You know, be it through a grant or a loan, in cases where utilities are already creditworthy, perhaps the pandemic has, you know, reduced their creditworthiness. Perhaps they would still be able to get commercial loans if the facility were to provide a guarantee. So that's, you know, one big design consideration. Of course, you know, utilities would love to receive grants, but some considerations to think there on the fiscal impact side. If the national government is receiving loans, you know, can it pay those back if it's on granting most of the money to the utilities? And then over here on the right-hand side, lots of other considerations to keep in mind, such as, you know, how to determine both to estimate and then in terms of structuring, you know, what amount of money should be provided, whether it's really focused on the direct impacts of the pandemic, or something broader, like any funds needed to continue operating, which might help cover some past deficits that utilities have incurred. Similarly, any restrictions on the use of funds kind of goes hand in hand with that idea of what amount do you provide. And then finally, you know, linking reforms in some way, whether it's immediately or later on or not at all, to this financial support. Some of the bigger picture reforms like tariff reform, governance reform, and more, and operational reform too. You know, is this an appropriate time to, you know, when utilities do really need the money urgently, to bring in these conditionalities? So yeah, that's a quick kind of 3-minute overview of what the next session will be about.
Thanks very much, Shannon. With that, I see that our time has come to a close. As you sign off, the Zoom platform is going to give you the opportunity to complete a short survey. Please, please, please provide your feedback to us. We want to continue this lecture series. We want to bring you information that you are interested in, and we want to continuously improve. So definitely appreciate your time to fill that out for us. Also, please check out the ROCKBlue website at rockblue.org. On there you will find a series of blogs by industry experts, including several by our presenter, Jeremy Gorelick, here today. And please reach out to us if you are looking for additional information, would like to learn more, or if you're a utility in need of assistance. We look forward to hearing from you, and we hope you will join us for our next lecture hosted by Shannon and Castalia on the Emergency Pandemic Response Financing Facility. Thanks again for joining us tonight, and apologies to any that we didn't get a response to your question today. Please feel free to drop us an email, and we'll do our best to get back to you. Thank you to everyone, and especially to our presenters.